We're excited to kick off our fall webinar series. We did a summer webinar series that was well received. It was well enough received that we decided to do a few more of these here as we finish out the year. And as we get into the end of October, it's as good a time as any to talk about. I mean, I think for a lot of people that we've talked with, they're talking about their September statements and the dreadful September that we had, as bad a month as we've had since COVID, frankly. But that's the story on 2022 isn't written quite yet. And I think when we have some of these discussions, we mix the economy, what's going on with the economy, what's going on with markets. And so our speaker today is going to help pull those things apart, I think, a little bit and give us a little bit of perspective on what's going on, what we should be looking for as we go forward, not just these next couple of months, but as we go forward and look into 2023, and kind of give some good perspective. So I will go ahead and introduce Mira now, and then we can kind of get into this a little bit. Mira Panda is a global market strategist with JP Morgan Asset Management. She's been there for more than a decade. And she has provided her commentary to us and to our clients here for a number of years now, whether it's been through webinars like this on our podcast. And we are not the only ones who seek her expertise. She's also a frequent guest on Bloomberg, Yahoo Finance, CNN. And as I was just telling her, as I was having my morning cup of coffee on Monday, she was on at the desk on CNBC giving her commentary on what the market outlook was for as we go forward on this year. So, Mira, I will hand it over to you, and I will share our screen here so everyone can see your slide deck. I will say, I guess maybe just quickly before I do hand it over, if you have questions, we welcome your questions, and we can, if you can put it in the chat or put it in the Q&A section of the webinar, I'll go ahead and relay those questions to Mira and she can answer them on the fly. And then, of course, we can wrap up a little bit at the end with any Q&A that we have after the fact. So, Mira, I will hand it over to you. Thank you.
Great. Thank you. And thank you all for joining and for your time today. We have certainly had interesting markets, and the economy has been one for the books this year. And so from our team's perspective, it's been challenging to really distill down what's going on to just a couple of themes. Nevertheless, we always endeavor to do so. So if I think about the broader theme for this year, given what we've experienced in the economy and markets, is that, if we think about the economy slowing down, potentially headed towards recession, we don't think we're there yet, but we certainly want to acknowledge the risks that recession is on the horizon and something we think could very well happen in 2023. But we've also seen a very dramatic sell-off in the markets in both stocks and bonds already this year. And we have dug back into history and taken a look over time. And what you tend to see is that markets bottom before the economy. And I think that is really instructive for how we're thinking about portfolios, because although we may not be yet at the worst of the economic pain, we've probably seen a lot, but not all, of the market sell-off that we're going to see. So something really important to keep in mind, especially given the fact that valuations have reset across the board, again, in both stocks and bonds, and that could actually set us up in the longer term for more attractive returns. So let's start with the economy on the next slide. The US economy is slowing after a very strong expansion. So what you can see in the chart on the left is real GDP over time, so economic output. You can see that dramatic decline all the way on the right when we hit COVID. You can also see a very sharp V-shaped recovery. Last year, the economy was essentially growing at a 6% rate, 3 times what we typically see. So very strong expansion in 2021. But more recently, we've been seeing a little bit of a slowdown in economic growth. And of course, we've had 2 negative quarters of GDP, which has most people saying, we think we're already in recession. I think we're close. I think that a recession is certainly on the horizon, given as much as interest rates have moved higher and the Fed has been tightening. I think it's highly probable. And yet, I don't think we're there yet. Why is that? Well, a lot of what drove GDP to be negative in the first 2 quarters of the year, slowing inventory growth, massive amounts of imports given the high dollar and heavy consumer demand, and a fiscal drag from less government spending don't necessarily tell you a lot about the health of the economy. In fact, what does tell you about the health of the economy, if you look at the chart on the right, is the consumer, because consumption makes up about 70% of our overall economy. So the health of the consumer really gives us indications in terms of how the economy is doing. So how do we look at the consumer? Well, if we take a look at the next chart, what we can see here is a heat map of different variables that actually help to determine a recession. Again, a recession maybe technically is 2 quarters of negative GDP growth, but in reality, a committee from the National Bureau of Economic Research determines whether or not we're in a recession, and they look at these 5 factors. They look at income, they look at spending, they look at industrial production to understand manufacturing activity, they look at retail sales, again, to understand consumer activity, and they look at jobs. So we've shown those 5 measures here, and actually 2 different measures for jobs. And what you can see over time here is green is when things are strong, yellow is when things are slowing, red is when things are contracting. And on a month over month basis, if we look over recent data, we're still broadly in that yellow territory. And in fact, from a jobs perspective, we're kind of a little bit more in the green territory. It's hard to say that we're in recession when we are still adding hundreds of thousands of jobs into the economy each and every month. Another look at this is on the bottom chart. We look at those same factors in the heat map, but we look at the last rolling 2 quarters to understand, okay, how does this align with 2 negative quarters of GDP? And what we can see across the board is except for retail wholesale and retail inventories, or retail wholesale and retail sales, I should say, we're seeing that a lot of these measures are still continuing to increase at a much slower level than last year, but are still increasing. Now, when the economy turns, it tends to turn fast. So there is no saying that we can't start to see even more deterioration here and eventually get to this red zone. But again, we don't think we're quite there yet. We may have another 6 to 9 months or so until we believe that we'll end in and enter a recession. Now, when we hear the recession word, we think about 2008 and we think about COVID, 2 very severe recessions where we didn't even have to keep a tracker to understand whether or not we were in recession. It was plain to the naked eye that we were in a very severe economic environment. And yet right now we're kind of continuing to debate, as we have over the last several months, are we in recession? Are we not? And I think what that signifies is if we are, it's very mild. If we're going to be, we think we're again, probably going to be in something a bit milder. And there's a couple of reasons for that. One reason is that we tend to see cyclical excess build up in the economy before a recession. So we're making too many cars, we're building too many homes, we're spending too much from a company perspective, we're building up too much inventory. And right now we're not seeing excess in any of those areas. So, my boss always likes to say it's hard to get hurt falling out of a basement window. That's where we are in a lot of these cyclical factors. The other major factor, which I alluded to earlier on the next slide, is the fact that we have a very strong labor market. What you can see on the slide here in that gray line is that the unemployment rate is about 3.5%. We briefly skirted with 3.5% pre-COVID, but before that, you'd have to look back to 1969 to get to that type of low unemployment. So unemployment is very low. A lot of people say, but what about participation? We haven't seen people come back to the workforce. Well, actually, if we look at people aged 25 to 54, that bulk of the workforce there, participation rates among that cohort have broadly recovered. What hasn't recovered is people in the sort of 55 plus category. A lot of people retired. A lot of those people are not going to come back to the workforce. That's been a demographic change in train for a long time now. And that's leading to the structural labor shortage. It's a mix, demographics, different legal immigration policies. All of this is leading to a lack of supply of workers. Now, on the one hand, what that means is look, if people broadly have jobs, that is a good thing, particularly headed into recession. Not to say that we can't see higher unemployment during a recession, but perhaps not the same heights as we did previously. And also maybe jobs can come back faster, just given the fact that people are looking for labor. If you spent all this time trying to find the perfect person, raising wages in order to do so, it's going to be really hard to want to let them go. We're going to see layoffs in the next recession, but maybe somewhat more limited, and maybe again, people come back pretty quickly. So on the one hand, it is good that people have jobs. On the other hand, because we have this shortage in labor supply, that means that when businesses do want to hire people, they have to raise wages. So that blue line there looks at year over year wage growth. You can see a little bit of noise towards the end of the line because it represents kind of different industries coming back after the pandemic at different points, but the broader trend is there. We didn't see a lot of wage growth over the last 10 to 15 years, but we are seeing a lot of wage growth now. Now, the issue with that is that the worker is the consumer and the consumer is the worker. So if you put more money in the hands of the worker, who's also the consumer, they're going to spend that. And that can put upward pressure on prices, which is why the Federal Reserve, our central bank, is pretty closely watching wage growth as one of the indicators of where they think inflation is going. Now, on the next slide, inflation is the biggest challenge plaguing our economy right now, not just ours, but global economies as well. It is at a 40-year high. And if we can see this slide here, we can see headline CPI, the consumer price index in blue, broad measure of prices across the economy. And then in gray, we can see the core CPI reading, which essentially is X food and energy. And on both of these measures, we're still seeing very high readings continue to come in. That being said, we look at a lot of evidence across the economy that inflation has peaked. If we think about energy and commodity prices, they're still high, but they're off of their June peaks. If we think about supply chain issues, we look at input prices, delivery times, shipping rates, boats that are parked out of the port of Long Beach to see how long it's going to take for people to get their stuff. And a lot of that has peaked and has started to come down pretty swiftly. You hear from some of the big retailers, the Targets, the Nikes, the Walmarts of the world saying, actually, we have a lot of extra stuff that people don't want to buy. People bought a lot of their goods during the pandemic. And that caused a lot of supply chain challenges too, as there was so much demand while it was hard to get things around the world. And now we're seeing the opposite of that. And when they have to put those things on sale, that is disinflation. Services, we haven't yet really seen a lot of disinflation in services yet. But a lot of people took their big trips to Italy and they're, have been going out to restaurants over the course of the summer. And we likely are going to see that start to slow because prices are still high. So overall, we think some of those areas can come down. From a shelter perspective, rents actually might get a little bit worse before they get better. We're seeing some of the rent data and some of the housing data start to slow. That's going to be kind of the last holdout when we think about inflation. So that will likely continue to increase the rest of the year until at some point next year. But all of this is to say, we're finding little bits and pieces, whether it's on the demand side with things like goods and services, or on the supply side with energy and food prices or supply chains, that some of this stuff is starting to roll over. It'll take a little while to work its way into the official statistics, but slowly but surely it should. And I think next year will be a year of disinflation when we continue to see inflation increase, but at smaller and smaller increments, getting closer to the Fed's 2% target by the end of the year. Again, it will take some time. We may not be able to get all the way down to 2%, but we feel pretty confident about the direction of travel. It's just how quickly that can happen. The speed is the question. The other question is, how much economic pain do we have to endure? Likely some form of recession in order to stamp out inflation. But the question is, how severe, how much? Again, we're thinking on the milder side, but we very well might need to see a recession in order to get inflation to a better place. Now, in the meantime, we're continuing to see the Fed do what it can to bring down inflation by raising rates. So if we take a look at the next slide, this slide looks at the federal funds rate over time. That's the key benchmark policy rate that essentially governs all other interest rates in the economy. And it has moved from about 0% 6 months ago to about 3 to 3.25% within that range today. And next week, the Fed meets. They're likely to raise rates by 0.75 points. That's going to bring that top end of the range up to about 4%. So you can just see, like, compared to prior rate hiking cycles, you see 2015 to 2018 there, very slow and steady. This has been really fast and furious. And then if we think about where rates are going to continue to go, we are mostly there in terms of Fed rate hikes, but we probably have a little bit more to go. Again, inflation is still over 8%. While we think that can come down, probably the Fed is not quite ready to take their foot off the gas. So what we can see in the blue line is the Fed projections of where they might need to see rates going over the next few years. So you can see 4.40 by the end of the year, 4.6 by the end of next year. And then you can also see market expectations in green of where the market thinks the Fed needs to go. So there is some question as to, if we think about the December Fed meeting, if they continue going at the very aggressive pace that they have been going, or they start to ratchet that down. Either way, they are going to be at a rate level that is probably somewhere between 4.5% and 5% based on what the inflation data is showing now. But they've been incredibly sensitive to CPI data and jobs data, as we look at wages coming in. So it's a little bit too early to tell what they do in December. It's going to depend on the next two jobs reports and the next two inflation reports. All told, though, we're probably closer to the end, certainly than we were at the beginning. And we could potentially see the Fed pause their rate hikes at some point next year. Now, they're probably going to keep rates high in order to not allow inflation to start creeping back up. So something to consider when we think about these yield levels. But nonetheless, they are working pretty aggressively to tame inflation, which we think is likely. It's just, again, going to take a bit of time. Now, if we take a look at the next slide, clearly what we've seen from a Fed perspective is they've shifted the goalpost throughout the year of how much they thought they were going to raise rates. I mean, remember at this time last year, the Fed would have said, we may not need to raise rates in 2022. It's just staggering to think about how quickly that readjusted from December when they said, okay, we're going to start raising rates in 2022 at some point. By January, they said 3 hikes, and it was 4 or 5 hikes. At this point, if we think about the quarter point increments, we've seen double-digit quarter point increment hikes by the end of the year, and that has had a really dramatic impact on the bond market. So what you can see in this slide here is we look at different Treasury maturities. So 2-year Treasury, a 10-year Treasury, a 30-year Treasury, back at the beginning of the year in gray, and the yield that they offered, and then we look at it where those yields have gone to today. And we have seen a dramatic reset in yields. I mean, that gray shaded area looks at the yield range over the past decade, and we have shot up within a matter of 10 months from kind of closer to the bottom end of that range to creating new heights in that range, actually. So the 10-year Treasury yield, for example, went from a 1.5 to about 4.25. And things continue to move. We're closer to about 4% today. And remember, October 24th, so it was like 2 days ago. So yields have been moving fast. They have been moving sharply. And that has created a lot of pain for fixed income investors. It's very rare to see inflation at these heights. It's been 40 years since we've seen anything like this. And therefore, it's also been about that same amount of time since we've experienced these types of challenging bond returns. But I would invite you to think a little bit more about where we could be going relative to where we have been. Because if you look at this yield range, it's not to say that yields can't move a little bit higher on balance, but once we kind of get to the Fed pause point, that's probably going to be the limit to how much yields move higher. And there's a lot of scope for yields to fall. And remember, if we do end up in a recession next year, which we think is more likely than not, that's going to be an environment where all of a sudden we probably see yields start to fall. And when yields fall, bond prices rise, so we can start clawing back some of the losses that we made this year. In fact, if we think about dynamics going forward, not only are you getting 4% yields in many areas of the bond market without actually having to take on that long of a term that you'll have to hold it, you take 1 year, 2 years, and you're still getting really attractive income for the first time in a long time. But also, again, that scope for yields to fall, for bond prices to rise, and to protect your portfolios coming back. So it's been a while since we've seen that bonds are able to protect portfolios and provide income. That dynamic is going to start to come back. Now, on the next slide, this is another kind of cut of that. What you can see here is the gray bars look at the yield range over the last 10 years. So the prior page was just looking at treasuries. This is a lot of different areas of the fixed income market. You kind of have some of your more core bond areas on the left. treasuries, municipals, different types of asset-backed securities, corporate bonds. And then on the right side, you have some of your kind of more extended sectors. If you want to pad things out with a little bit more income in high yield or emerging market debt. And what you can see across the board is, again, yields at very high levels, which also means that bonds are cheap. So bonds are cheap and can offer income going forward, which actually makes this a really attractive entry point when we think about fixed income. And for years now, we think about that 60-40 portfolio. People have really liked the 60. People haven't really found the 40 all that attractive. We're hearing more and more conversations that people are more interested in that 40 portion of the portfolio, the bond portion of the portfolio, while they're feeling a little bit nervous about the 60, the equity piece. So I think that's a good sign that yin and yang is kind of coming back, where that diversification helps and things can operate differently in different environments. Now, on the next slide, on the equity front, of course, this dramatic repricing in yields has meant a lot of volatility in the equity market as well. What you can see on this slide here is S&P 500 calendar year returns, and also the maximum the market fell in a given year in these red dots. So essentially what you see over time is that the market can fall in any given year about 14% on average. And you can see some outliers here, like this year, where things fall even more than that. But as an investor, if you have suffered the sell-off, you are often eventually rewarded with a rebound. And actually, calendar year returns were positive in 32 out of the last 42 years. I'm not saying that this is the case this year. We have a pretty short window to the end of the year. But if we think about some of the catalysts for stronger markets, and I think one of them is the Fed pausing its rate hikes and eventually, hopefully, in future years, cutting those rates back down to a more breathable territory, that can start to lead to a turnaround in the equity market. So we do want to be patient here because we have already suffered this sell-off, and maybe we have a little bit more to go. But I think that we're 70 to 80% there. Now, if we take a look at the next slide, what this has also meant is that valuations have reset. How cheap or expensive stocks are. So this slide looks at the S&P 500's forward price to earnings ratio. Again, how cheap or expensive stocks are, more expensive as you move higher, cheaper as you move down. And right now we're at about 15 times forward earnings, below that longer term average. And, a lot of people say, okay, well, are we at the bottom? I don't think we're quite at the bottom yet, but whether we're at the absolute bottom or we're just near it, when we see valuations reset like this, we tend to see forward-looking returns on a multi-year time horizon can be pretty attractive. Don't expect much out of the next few weeks and months, but again, over a multi-year time horizon, we could be looking at some impressive gains. So to show you what that might look like on the next slide, we've essentially illustrated what would happen or what kind of returns could we experience just mathematically on the way back up if we get back to the peak in the S&P 500 that we experienced in the beginning of the year. Let's say we don't see that peak anytime soon, not by the end of this year, maybe not even next year. We still have the Fed, we still have a potential recession. Let's say it takes 3 years to get back to that peak in the S&P 500. What you can see in the chart on the left is looking at different increments, what kind of returns based on where markets are today you could expect on the way back up. So for example, if we look at 3 years, let's say it took 3 years for us to regain that prior peak, seems like kind of a long time, but you'd be looking at almost 10% returns each and every year on the way back up. If you look at shorter time frames, you are potentially looking at double-digit returns on the way back up. So again, if we think less about where we've been and more about where we could be going from here on out, again, if you suffered that sell-off, you certainly want to be rewarded with that rebound. Now, on the next slide, I think that in times where there's a lot of volatility in the markets, where things are very interesting, we want to be as steady as possible. So we turn back to some of our time-tested principles for investing. And I think 2 really important principles is maintaining that patience and that longer-term time horizon, and also being diversified. So this slide looks at the power of both of those things. So you can see on this slide a range of stock in green, bond in blue, and 50-50 stock bond portfolio returns over rolling 1, 5, 10, and 20-year periods, all the way back since 1950. And what we can see here, for example, is if you were invested in the stock market any one year, back since 1950 in green, that first green bar there, you could have had a year where you had a 47% return. You also could have had a year where you had a negative 39% return. But when you add a little bit of bonds to that, you can see in that first gray bar there, that 50-50 portfolio, you start to compress that range of outcomes. And the longer you go out, the more you can compress that range of outcomes. And in fact, over a 5, 10, or 20-year rolling period, back since 1950, you do not have a period where that 50-50 portfolio is negative. Again, really illustrating that power of being a bit diversified and also, again, being a little bit patient with our investments, because that tends to dampen these shorter term bursts of volatility. You know, a lot of people think that volatility is the portfolio killer. Volatility is not the portfolio killer. It is actually a feature, not a flaw of the market that does create opportunity. And the real portfolio killer is how we act during times of volatility. Being disciplined is so incredibly important because sometimes people get out of the markets. They wait too long to get back in. And the longer term risk there is that they're not invested long enough in order to eventually reach their investment goals. So they get to retirement, they get to like making the down payment on the house or, the second home or whatever it may be. And they don't have enough money because they weren't as disciplined as they could have been in portfolios. So something to kind of keep in mind there. If we look one slide forward, I think I have one slide left. Yes. Okay. So, I think it's important to acknowledge, though, that this has been a year where diversification has not worked. The challenge when you have high inflation and you have to raise rates is that higher rates are that, or rates in general, are sort of that common denominator between how a stock is valued and how a bond is valued. So rates move higher and it pushes down the value of both your stocks and your bonds at the same time. That does not tend to happen. This is, again, a pretty unusual environment. So if you'll recognize the format of this slide, very similar to what we had seen a few pages ago just on the equity market, but we've added the bond market to this in gray. So the green section is the equity calendar year return. The gray is the fixed income on top of that. So you can see that sort of 60-40 portfolio return on a calendar year basis. You can see for the most part, it's pretty rare. Again, if we look back over history, I don't really think on this page we have a period of history where we've had both the gray and the green down. So this is an unusual environment. But you also see that average annual drop of about 8%. And yet, if you look over the course of the slide, double-digit drop that we've experienced so far this year is not entirely unprecedented. There's actually 9 instances where at some point in the year, we have a double-digit drop in the 60-40 portfolio. And if we look 1 year later, in 8 of those instances out of the 9, we have positive calendar year returns on the 60-40 the following year to the tune of about 17% on average. Again, not saying we're going straight up from here. I do want to be realistic, and we are certainly a bit cautious right now when we think about investing, but there is certainly room for a rebound over time. So maybe with that, I will pause there. Happy to answer some questions, but just to recap, we're not at the worst of the economic pain yet. That's probably what lies ahead. But what we have seen over time is we tend to see markets bottom before we get there. So we want to keep that in mind when we consider how much valuations have reset and how much of the sell-off we have already experienced.
Thanks, Mayor. I think that gives some pretty good insight into what's going on. Particularly, the obsession for many people is with the stock market and what's going on with the stock market, but bonds have been truly part of the struggle this year. And for folks who have more conservative portfolios, there's this tendency to own quite a bit more in bonds, and the struggle has been even more difficult for the people who maybe can least afford it or stay up at night because of the ups and downs. While we wait for some questions to perhaps roll in before we finish up here, I did want to, if I could go back and ask a quick question on a slide that's a little bit earlier, one that gets referenced all the time with this equity drawdown mid-year. You can't help but notice here that the last time the S&P 500 actually registered a negative return for the calendar year was 2018. And in that year, Jay Powell said interest rates increases were on autopilot, rates were going higher. We were in a midterm election year. Do you think there's some parallel here? And if there are, do you think the midterm election has some impact on where we may go from here?
Definitely some parallels here. I'm actually zooming in on the slide on my phone here. It's a little bit harder to see, but you can actually see the same thing in 1994. You have a negative 2% year. Maximum the market fell was about 9%. And 1994, 2018, and 2022 have some very similar dynamics in that all three were and are midterm election years. And in all three, you see the Fed tightening towards the end of the year, and then actually starts to take a pause at the beginning of the following year, and then actually cuts by the end of that following year. And not all the way down to zero, just modest cuts. Maybe less modest in 2019 than in 1995, but in 1995, you were still kind of in relatively restrictive territory or higher territory on rates. So some real parallels there, and I'm glad you pointed that out. When we look at midterm elections, because we have spent a lot of time on this, what we tend to see in a nutshell is, yes, you do see more volatility and lower returns in the lead up to midterm elections. If you look at quarterly returns on average, your average returns in the first 3 quarters of a midterm election year are 1%, negative 2%, and 0 on the S&P 500. The fourth quarter jumps to about 7%. So what you tend to see is that it actually does not matter what the outcome of the election is, even a presidential election, because that's what we saw in 2016 and 2020. Markets do tend to rally after elections because a source of uncertainty is relieved. And the less uncertainty, the easier it is for markets to price. So we do tend to see these post-election rallies, again, regardless of the result. Now, the 2 exceptions to that in recent memory were in 2018 and in 1994, because the Fed was continuing to raise rates. And ultimately, the Fed is more influential on the economy than in an election. If we think about what has been the driver of returns this year, it's the Fed, and it will continue to be. The Fed is the signal, the midterms are the noise. So we don't want to get too bogged down on them. Maybe we could see a little bit of a post-midterm rally here, but again, I think that the fact that the Fed is continuing to raise rates is going to continue to weigh on returns in the last quarter of the year. That being said, you can see on this chart 1995, and you can see 2019, and how markets tended to rebound once the Fed did pause. It could be a little bit different this time if we're headed into recession, and if rates are still left at a very high level. But I do think you're going to see some degree of relief in markets next year once the Fed does start to hold steady.
I think that's a great take, because we've got a very busy, well, we're in earnings season right now, but as we begin November, a very busy week between the Fed meeting, jobs report, and then the election on the 8th. There's going to be a lot coming here down the pike for markets to digest.
Yeah, you're getting another inflation report shortly thereafter as well. If we think about global, we don't always have to think about global because global economies don't always affect the markets as much. But that's not been the case this year. If we think about bond markets actually being impacted a lot recently by what's going on with Europe and with the UK in particular. And we're probably not only going to see a 75 basis point rate hike from the Fed, but also from the Bank of England, also from the European Central Bank, also from the Bank of Canada. So we're definitely seeing a lot of that going on all at once.
Absolutely. Absolutely. And as we've kind of been chatting here at the end, Mira, I don't see any questions in the chat or in the Q&A section. So I'll give it another second or so, but I think what really is going on here is you've covered it soup to nuts and kind of grabbed the whole kind of what we're dealing with here, both from a market perspective and economically. These are the tough, we're in the middle of the storm, if you will, but certainly after the fact, it's pretty clear with what you've shown that once the clouds clear, it becomes a whole lot easier going forward after we pay the price of the volatility here that we've gotten so far this year. So with that, Mira, I want to say thank you again for joining us again. Your commentary is always welcome, and we really value it here. So thank you, everybody. Thank you for attending our October webinar. We'll be doing another one in November talking about Medicare, but I think we'll leave it here for today. Thanks, Mira.
Thank you.